Today, we're answering a question that every beginner investor asks. What makes stock prices go up or down? Let's break it down in the simplest way possible. Stock prices change because of supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell a stock than buy it, the price goes down. It's just like any product. More demand equals higher price. Less demand equals lower price. But what causes that demand to rise or fall? Let's go deeper. People want to invest in companies that make money. So if a company reports good earnings, shows growth, or has exciting new products, investors get interested. That increased demand pushes the stock price up. But if a company has losses, scandals, or shrinking sales, investors lose confidence. They sell the stock, and the price drops. News plays a huge role. A positive headline or a big partnership can drive a stock higher. But bad news, like lawsuits, leadership issues, or product failures, can make the price fall fast. The overall economy impacts the stock market too. If the economy is strong, people have more confidence to invest, and stock prices rise. If there's a recession, inflation, or rising interest rates, investors get nervous. Prices can fall. Sometimes, prices move just because of emotion. Fear, greed, fear of missing out. These can cause big swings, even if the company's business hasn't changed at all. Think about the hype around meme stocks or tech stocks in a boom. People buy just because others are buying, and that can push prices way up or way down when the hype fades. When the Federal Reserve raises interest rates, borrowing money gets more expensive. That makes people less likely to invest in risky assets like stocks. So prices might go down. When interest rates are low, stocks often do better because investors are chasing returns. Stock prices are based on what people expect to happen in the future. Even if a company isn't doing great today, if investors believe it will grow tomorrow, they might start buying now. That buying increases demand, and the price goes up. So to sum it up, stock prices change based on supply and demand. But supply and demand are influenced by company performance, news and media, economic conditions, investor emotions, interest rates, future expectations. Investing isn't just about numbers. It's about people, psychology, and big picture thinking. If this video helped you understand what moves stock prices, hit that like button, subscribe.